Hello friends, how are you doing out there? Last week, I advocated that the markets might hit a new high pretty soon. Well, it didn't really happen. Although the bank Nifty hit an all-time high, the Nifty went up only to flatter and deceive the bulls. A fortnight ago, I told you everything depended on the banking stocks, and sure enough, Bank Nifty led the way up. And last week, I advocated that these were VUCA markets: volatility, uncertainty, complexity, and ambiguity, and earning trading profits would be a little more difficult, even though the headline indices would be appearing to rally. The trader would find it a challenge to garner trading profits, and that is exactly what happened. Now, in this video, I want to analyze what went wrong and what must go right before you can expect the continuation of the up move, if at all. On your screen right now is a market roundup window which tells you that it was the banking space that led the upthrust, and the broader base Nifty 50 actually lost a little. The US dollar index stabilized and even rose a little bit, which triggered profit taking in crude oil, but natural gas went up due to seasonal considerations. Gold went up a little, silver fell. Not a surprise here. The dollar is appearing to basically find its own feet. The USD INR went up, which is the Indian rupee weakened against the United States dollar. 10-year benchmark bond yields went up, which means bond prices fell. And that is what restricted the Bank Nifty's upthrust. The NSE lost 0.8% in market capitalization, which is expected in a weak outlook. MWPL gained a little, but we are going to come to MWPL specifically in a brief while. The US market indices surrendered some ground, which means the overseas cues provided some headwinds. On your screen right now is the daily chart of the Dow Jones Industrial Average, which has basically consolidated around the 33,272 levels. This is a level that we talked about last week as well. It fell on 3 out of 5 trading sessions last week, and the 34,281 level is what I want to watch. The death cross, where the 50-day moving average is below the 200-day moving average, remains in place, but the 50-day average is rising. So I guess the litmus test for the bulls is whether they can take the Dow above 34,281 and keep it above this threshold for a while. Let's wait and watch. Now, the Nasdaq 100 index, which directly impacts our technology stocks, this also has a death cross. As a matter of fact, the death cross came first in the Nasdaq compared to the Dow, and the price is above the 50-day moving average, which remains below the 200-day average. But relatively speaking, this chart is not half as strong as the Dow. What we need to watch out for is whether the 11,682 level holds. Can the bulls keep this index above this threshold? Now, the broadest index of them all, the S&P 500, here again there's a death cross, and what we need to watch out for is 3,905 as a support and 4,119 as a resistance. The bulls will start to get an upper hand only above the 4,119 levels. Coming back to our markets, our in-house indicator, the MWPL, which I told you we'll talk in a little more detail, has rallied to its highest after the September expiry. In October, we had a very tepid and low conviction peak at 29% on MWPL. But what I did notice, friends, and if you're connected with me on social media, on Thursday, the MWPL went to 33 plus. On Friday, it has fallen below the 33 level. Now, MWPL routinely falls in the week of expiry, monthly expiry. But this time around, the fall has come a little earlier. That tells me that conviction levels were a little wobbly. They were a little shaky. So the first criteria of what must happen for the rally to gain ground is MWPL must rise. As a matter of fact, I would prefer it to rise above 33.59, which is the peak it made in the September series. So will that happen? Let's wait and watch. Now on your screen is the index and stock futures turnover of 3 concurrent series, which is November, December and January. What we are seeing is that the index futures turnover continues to fall for the 5th week in a row, whereas stock futures continued to rally a bit for a fortnight in a row. So action is actually shifting from indices to individual stocks. Now that to me is a sign of higher risk appetite. We are going to come to that, the retail risk appetite at the fag end of this video. Now for the advanced decline ratio, which basically is showing a decline for the 2nd week in a row. Now what I have done is tweaked around a bit and taken a week's average of the NSE advanced decline ratio and a week-on-week close of the Nifty and gain and loss of the Nifty. So the Nifty lost 0.23% as compared to its prior week, but the NSE advanced decline ratio fell to almost its lowest level in 20 weeks. Now that tells me that Marshmallow traders, the intraday guys, were lacking the conviction to take this index, the advanced decline ratio, higher. It must stay above 1.0, ideally even above 1.25, 1.50, with rising prices for the bulls to remain in the driver's seat. So this is criteria number 2. The advanced decline ratio must rise and the turnover must rise with rising prices for a bull market to ensue. Coming to the basis is nothing but the premium or discount prevalent in the futures compared to cash. Basis for the Bank Nifty fell off a cliff from 156 and a quarter in the week prior to 67.75 last week. That's a big drop. The Nifty basis also fell from 74.30 to 48 and a quarter. Now time decay, just like options premium, also impacts futures basis. So part of it is attributed to theta decay, or the closer we get to expiry, the lower is the basis. But I saw definitive signs of profit taking at higher levels in both indices, and that is also something that you need to watch out for. As long as the basis remains positive, that means above 0, the bulls still have a chance to salvage the situation, but the basis needs to rise. It needs to go up. Don't worry about it. I post this chart every day on my social media, especially on my Telegram channel. Do connect with me there and stay updated. Now, for our in-house exclusive indicator, the impetus, which has served you well for over a year and a half, and this is one of the bedrocks of our statistical trading model, which we use for our in-house high-frequency trading, the impetus. The Bank Nifty impetus has risen along with the Bank Nifty's price rise, whereas the Nifty's impetus continues to fall for a fortnight in a row. That is the third worry. And therefore, the third criteria in case the banking and the Nifty 50 need to rise in tandem, the impetus of the Nifty must play catch up with the Bank Nifty, failing which, I have told you in my live mint column, this market is like a bicycle. The Nifty and Bank Nifty are its two tires. You cannot move forward with one tire being flat or punctured. Both the indices must have a healthy rally for the bulls to be in charge. So criteria number 3, I want Nifty 50's impetus to rise. LWTD, our latest indicator that I have shared in my videos, the lift weight thrust drag index vis-a-vis the Nifty's percentage gain loss in the spot. Well, the Nifty has lost 0.23% on a week-on-week basis, but the LWTD has risen marginally, but it still remains below zero at minus 0.11. What it means is that while overall buying support will remain a kind of weak, lackluster, but it will be better than the week gone by. And if the LWTD rises further and stays above the zero mark, the bulls will resist big ticket declines. Where do you get this LWTD? Only with us, and I do share it on my social media accounts, so do connect with me. My contact coordinates come at the fag end of this video. Now for the footprint of the four market participants, I start with the FIIs who've increased their net long positions in index futures and cut down their net long positions in individual stocks. So they are playing a hedged game. Reduce long positions in stocks and increase long positions in futures. DIIs continue to remain short. Remember, they buy in the spot segment and hedge those long positions by going short in futures. So they've cut their individual stock futures shorts marginally and they've increased their index shorts marginally. Here again, they are playing a hedged game. Prop traders. Now these are very sharp, savvy players, brokers own trades who know who's buying, how much, at what price, and therefore they are second best to insiders. These guys have cut short their individual stock futures long positions marginally by approximately 12,000 lots. But they've cut short their index net short positions as well. So what they are basically saying is they are reducing their exposure net and preferring to convert to cash. Now let's see what the retail guys have done. These guys have done all the heavy lifting after the COVID-based lockdowns were imposed. They've actually gone gung-ho. They've increased their individual stock futures net long positions by approximately 31,000 lots. At the same time, they've reduced their index net long positions by approximately 10,500 lots. So here again, they are playing a hedged game. So last week is actually appearing to be a week where people were not sure about which way the market's going and therefore they were sitting on the fence. Friends, I now analyze what the four index heavyweight stocks are doing, because wherever these stocks go, the indices follow suit. Two of these stocks are constituents of the Nifty and the Bank Nifty, and therefore whichever way these stocks go, they impact both the indices. I start with the biggest boy of them all, Reliance Industry, with a weightage of 11.03% and a beta of 1.09%. This stock actually fell on 4 out of 5 trading sessions last week, but it remained above its 25-day moving average, which is a month-long holding on cost of an average bull. What I would want is the stock to close above the 2,618 level consistently, and ideally speaking, even go past the 2,677 mark to trigger a next round of bullishness in the Nifty 50. Do remember, this is the highest Nifty weighted stock. The second highest weighted stock in the Nifty, HDFC Bank, with a weightage of 8.26%. The highest weighted stock in the Bank Nifty at 25.61%. This is a very critical element in both the Nifty and the Bank Nifty. It has shown signs of consolidating last week, although it's risen on 3 out of 5 trading sessions last week, but the humongous rally on the previous week's Friday has resulted in a consolidation thereafter. Price remains above its 25-day exponential moving average, which is a month-long holding on cost. And as long as the bulls are riding the stock above 1,541, they still remain in control. So HDFC Bank positive, Reliance is on the fence. The third heavy weighted stock, Infosys, with a weightage of 7.06%, Do remember the Nasdaq 100 attempted to rally but very feebly. So what we want is that this stock remains above the 1555 mark. It's above its 25-day exponential moving average, which is itself rising, and it's approaching a previous swing high close to the 1640 odd levels. It needs to close above that mark for the bulls to get comfortable and get back in the driver's seat. So watch Infosys. Now for ICICI Bank, the last of the four big heavyweights, enjoys a 7.94% weightage in the Nifty and second highest weightage in the Bank Nifty at 24.62% after HDFC Bank. The stock remains above its 25-day exponential moving average but unable to cross the 950 mark, which was a previous inflection point. What we do want is the stock to trade above the 930 mark sustainably for the bulls to come back with strength. So these are the four stocks that you must watch in the coming week. Friends, I now come to the bond market. It's an asset class which is very close to my heart, and I have been monitoring this segment for you way ahead of the others. If you are trading banking stocks, especially the Bank Nifty, you ignore the bond yields at your own peril. Now, bond yields, 10-year benchmark bond yields were almost unchanged, as you can see on the weekly chart on your screen, with the 7.55, 7.60 band being a double top kind of a formation here. What I would want is to see whether the bulls are able to basically keep the bond yields above 7.20 level. Now, this is one reason why I have been telling my online social media family to keep laddering bonds. You just don't know when bond yields will peak out for a while and then deny you the opportunity of sinking your teeth into mouth-watering yields. Do remember, equities still remain high volatility. These are VUCA markets: volatility, uncertainty, complexity, and ambiguity. So allocation to fixed income is a must. Now, much will depend on the outlook of the 10-year Indian benchmark bond yield, which will guide which way the Bank Nifty is going. So do keep your ears to the ground for the bond markets and don't ignore it. Friends, I now come to the US dollar index, which is a very critical element for emerging markets, including India, because our landed cost of imported goods depends on the USD INR, and which in turn depends on the US dollar index. So imported inflation is determined by the dollar versus the rupee. The daily chart on your screen tells you that the US dollar index gained on 3 out of 5 trading sessions last week, which is why net on a week-on-week basis there were marginal gains. The price is below its 25-day exponential moving average and far below its 25-day exponential moving average, which means a mean reversion or a pullback rally is always possible, or even a sideways consolidation before the moving average catches up with the current price. The 109.14 level is something I had advocated a fortnight ago. The price remained below that. The next support is at 104.51. As long as the bulls are able to defend this level, I think it might consolidate here. We'll take a fresh look if it is violated. The weekly chart on your screen shows that the US dollar index is below its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook is also turned negative. Good for emerging markets, including India, which will benefit from lower imported prices. The last candle is a bullish hammer, which means the bulls actually fought the bears and managed to take the price in the upper end of the week's range, although still below the 25-week exponential moving average. So last week's low at 105.15 will become a short-term bottom in place to watch. Now, last week I advocated a range between 108.90 on the upside and 103.90 on the downside, which held perfectly well. In the coming week, I expect a range between 109.42 on the upside and 104.52 on the downside. Friends, the US dollar index done. I now come to the Bank Nifty, which fell on 3 out of 5 trading sessions, but the gains were big enough to outnumber or dominate the falls, and therefore, on a net basis, the Bank Nifty ended up gaining 0.71% on a week-on-week basis. The daily chart on your screen tells you that the 41,840 previous swing high had been cleared earlier, and the bulls managed to keep the Bank Nifty trading above this threshold. We are now at an all-time high of the Bank Nifty, which was reached last week. The price is above its 25-day exponential moving average. Remember, I had told you a fortnight ago the market directions would be determined by the banking stocks. So now that the price is above its 25-day exponential moving average, which is a month-long holding on cost of an average bull, even the short-term buyers are in the money and they are not in a hurry to sell. So optimism still remains in the Bank Nifty. The weekly chart on your screen tells you the price is far above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook, though, is positive, also leaves the room open for some kind of consolidation or even some profit taking, because the moving average has to catch up with the price. Now, whether the price is coming down to the moving average or staying sideways to allow the moving average to come up will be determined by the fact that the bulls should be able to keep the Bank Nifty above the 41,840 mark sustainably. Friends, in the week before last, this index was at number 5 on our in-house statistical beta traders list, the highest in volatility rankings. It went up 1 notch to close at number 4 last week, which means the challenge for a retail trader just went up a little. Last week, I advocated a range between 43,600 on the upside and 40,650 on the downside, which held perfectly well. In the coming week, I expect an estimated range between 43,850 on the upside and 41,025 on the downside. Do keep your stop losses in place, and I would still suggest keeping your traded exposure small. Friends, the Bank Nifty done. I now come to the Nifty 50, which lost 0.23% on a week-on-week basis because it fell on 3 out of 5 trading sessions. As you can see on the daily chart, Friday's fall was a prominently noticeable one. Although the markets pulled back towards the fag end of the day, but the candle overall intraday range was fairly large. Also note how what I pointed out to you in my last week's video was that the 18,351 level, which was the 18th January 2022 swing high, needed to be overcome on a sustained closing basis. For 2 trading sessions, which is Tuesday and Wednesday, we managed to close above the 18,351 levels. Bulls were almost on the verge of getting out their champagne, but Thursday and Friday were dampeners. So, criteria number 4, if you want a sustainable rally, the Nifty 50 must trade above the 18,351 level sustainably and close above this. It should not close below this threshold at all. That would be criteria number 4. Coming to the weekly chart, what we are seeing is a bearish candle. Not surprisingly, we lost 0.23%. And we are at precariously poised at the 18,351 level, which is a previous swing high of January 22. Note how the price is above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. Medium-term outlook remains positive, but the distance between the price and the average tells you that mean reversion, which is either a decline or sideways consolidation to allow the average to catch up with the price, is always possible. Now, in the week before last, the Nifty 50 was number 11 on our statistical beta list. It fell 5 notches to number 16. No surprises there because on at least 3 trading sessions, I noticed the intraday range on the Nifty was this small. So when the ranges are compressing, the intraday volatility or pure statistical beta also tends to fall, which is why the rankings fell. It's not that individual stocks volatility has gone down. It's remained up. It's just the bank Nifty which is less volatile. Do remember what I told you. It will be more difficult for you to make money. The indices might appear calm, but individual stocks will be far more volatile. So it's still time for caution. Last week, I advocated a range between 18,850 on the upside and 17,850 on the downside, which held perfectly well. In the coming week, I expect an estimated range between 18,800 on the upside and 17,825 on the downside. Here again, trade light. Prefer to square up your trades on an intraday basis rather than carrying them forward to the next day, and do maintain your stop losses diligently. Friends, I now come to the latest segment that we've added, the risk appetite shown by the retail traders by way of their exposure in stock futures and options vis-a-vis index futures and options. When stock futures and options traded turnover is higher, it tells you that risk appetite is bigger because they tend to be more volatile, more span margin, higher premiums are required to be able to trade these counters, and therefore traders are saying, hey, I think I'm going to make more money, so let me deploy more cash. So on your screen right now, what you are seeing is that the sky blue line, which denotes the stock options turnover, shot through the roof on Friday. Although it is marginally below previous Friday's close, what we are seeing is that risk appetite, which fell Monday to Thursday, picked up on Friday again. The olive green line is the stock futures turnover as a component of the entire market. Here again, not as high as prior Friday, but it did perk up on Friday. And index futures turnover also perked up on Friday, which is thanks to the selling and profit taking on the weakness. What did the index options turnover tell us? It went up to Thursday, which is not surprising. It's a weekly expiry of the index options contracts. On Friday, the index options turnover actually collapsed, which is routine. The fact that it remained above the previous Friday tells me that risk appetite was marginally lower. All right. This is criteria number 5. Risk appetite must increase. Exposure in stock futures and stock options must rise significantly in the week ahead for the retail to display any signs of sustainable risk appetite. Friends, I now come to the most popular segment of this video for statistically inclined traders who are basically looking at the impetus readings of individual stocks. I give you 5 stocks which gain the most amount of impetus on Friday. So you take small exposure, wait for large price moves, and 5 stocks that lost the most impetus on Friday where you take big exposure, wait for small price moves. This helps scalpers. So statistical beta gainers list is led by Dixon at number 1, Astral at number 2, Kotak Bank number 3, Z number 4, and Tata Power at number 5. Impetus losers, where you take big exposure, wait for small price moves, list is led by Adani Enterprises, number 2 LIC Housing, number 3 Voltas, number 4 ABFRL, number 5 Whirlpool. Friends, this list is valid only for Monday. Should you want to be updated with this list on Tuesday through Friday, please connect with me on Telegram. My contact coordinates come in the description and in the pinned comment, as well as the fag end of this video. I would love to connect with my online family and share data with them free of cost. Before I sign off from this video, a reminder to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. And Tell me how my videos are helping you by giving me your feedback in the comment section. Thank you for your patience and sticking around with me in this video. Till we meet again in my next, this is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Thank you. Bye-bye.